Now I'd like to describe for you how Dow Wealth Management approaches this investment challenge. We're now ready to design and build a proper boat for our voyage, one that'll get us to our destination both assuredly and at a good pace. At first glance, it might appear that any design that addresses all of the foregoing will need to be complex with lots of moving parts. Let me illustrate for you how I view the intricacy of some people's investment strategies. A visual analogy of overcomplication. In my mind, this is a portfolio that tries to time the markets, futilely rotating from market sector to market sector. It's a portfolio that uses what I call buffet investing. It invests in some of everything. It's the kind of portfolio that suffers from unnecessary costs caused by the friction of multiple layers of portfolio management and product investing. Fortunately, a recurring hallmark of a successful investment program is that it tends to be simple to understand, and simple to implement. Now let me illustrate how we view our own investment approach. Simple and direct. In our view, an investment approach that takes a rocket scientist to decipher probably has something wrong with it. Or more cynically, the investment strategy is hiding something from the investor, usually high fees and high risk. In fact, investment success often is highly correlated with simplicity of design and execution. So let me caution you against what are often marketed as sophisticated and hard to understand investments by our industry. They have a depressingly high rate of catastrophic outcomes for their investors. Let's start with the most critical design element of this boat that we're constructing: avoidance of an irrecoverable portfolio loss. Because as we have said, the first priority of an investment strategy must be the preservation of wealth. We have identified two ways that our portfolio might get sunk. We can see our purchasing power erode because of inflation, or we might simply make a bad investment that becomes worthless. Let's first address the need to preserve our portfolio's purchasing power. Inflation usually won't damage a portfolio quickly. Even so, inflation is like a constant wind pushing us backwards. A decade from now, when we go to spend the funds, they won't buy nearly as much as they will today. One way to address the problem of ever-escalating consumer prices is to own assets for which their replacement cost rises because of inflation. Inflation means that it will cost more to rebuild our homes years from now, and it means that it will cost more to rebuild an office building. So if we own a house or a building, then even if we suffer through a period of high inflation, we might expect such assets to appreciate similarly. Ownership of equity, therefore, does something that cash in our wallets can't do. It can act as a hedge against inflation. In this regard, it probably doesn't much matter what kind of equity we own. We might own real estate, commodities, valuable paintings, or the common stock of corporations. With these kinds of assets, a depreciating currency means that it will simply take more currency to buy them. Our equity form of choice is common stocks. That is the form of equity that Dow Wealth Management uses in its clients' portfolios to help guard against inflation. When we own stocks, we own companies that in turn own factories and office buildings. They own patents and name brands. They own organizations of workers and client relationships. They own infrastructure. If we had to go out and replace those assets after an inflationary period, it would cost more to do so. Consequently, over time, stock prices tend to increase along with inflation, providing a measure of protection for shareholders and hence for our clients. Equity, of course, is a pretty broad classification. There are seemingly an infinite number of different forms of equity, but is a good start at defining our investment strategy. We still have the concern of an irrecoverable loss of our principal. As we saw at the start of the presentation, all financial markets and economies should be expected to suffer painful setbacks from time to time. Furthermore, we've learned that we probably cannot rely on anyone's ability to predict the next market crash in order to save us from financial disaster. We don't want to crash on the rocks just because we have an overconfident captain who proves to be badly wrong from time to time. If we cannot depend on a system to warn us of the coming financial hurricanes so that we can steer around them, then the only alternative is to build a vessel that is capable of taking the storms head on, especially rare major storms. We need a boat that has a sturdy hull. In terms of an investment portfolio, we accomplish this design criterion by building portfolios using high-quality securities. But what does high quality mean? A high-quality security is one for which it seems unlikely that the underlying company will go bankrupt, even during the worst of times. The ownership of high-quality securities may not be important during good economic periods, but they can be essential in helping to insulate a portfolio against catastrophic events that occasionally befall our economy. How do we determine the quality of a stock? For some people, quality is synonymous with the company's size and visibility. Dow Wealth Management's definition of high quality is much different. For us, high quality means that the underlying company has a strong balance sheet, a strong income statement, and furthermore, it means that the company has a long history of making enough money to pay its liabilities and dividends. In other words, any two people schooled in finance should be able to agree on whether a company is of high quality or low quality. This is not a matter of personal taste like deciding if a work of art is beautiful or simply a can of soup. If a company has a lot of debt, we do not buy it. If a company is losing money, we don't buy it. If a company does not have a long history of good and consistent earnings, we don't buy it. That is a fundamentally important step in trying to protect our portfolios from suffering a permanent loss of principal. In fact, I would suggest that it's our only reasonable hope, since we know that no one can predict with certainty the next economic crisis or market decline so as to avoid it. The best we can do, then, is to be prepared for the storm whenever it might arrive. To give us an even greater measure of protection, we don't place too much money in any single company. Rather, we broadly diversify the portfolio among a large number of high-quality stock holdings. Such a discipline helps ensure that, however severe the storm may be, the boat most likely will never sink. As a rule, we typically invest at least 80% of a client's portfolio in a diversified list of high-quality securities. Remember, we define risk as the potential for incurring a permanent portfolio loss. And as best we can in structuring our clients' portfolios, Dow Wealth Management tries to eliminate as much risk as possible. If someone owns a diversified list of the highest quality companies in the world, the odds seem reasonably good that his boat is going to stay afloat. He can probably go to bed at night and not concern himself that he may need a life vest. He would seem to be well protected against an irrecoverable loss of his principal. Even if there is an economic depression, the company's own would appear to be well suited to survive it. And if inflation takes hold, the equity characteristic of the portfolio would help preserve its purchasing power. Now it appears that we might have a theoretical investment problem. What I've just described seems to contradict the most enduring and immutable rule of investing. You may well have heard of it. It goes like this: there's no such thing as a free lunch. In investing, neither lunch nor dinner ever comes for free. And sadly, not even breakfast toast. What does that mean? It means that if we expect to earn an investment return, then we must pay a price. We must make some sacrifice. And the better the lunch, the higher the sacrifice. That seems to make sense. No one is going to pay us investors for doing something that's painless to do. If our investor with his broadly diversified portfolio of high-quality stocks isn't taking any appreciable risk, then why should he expect to earn much of a return at all? The reason is that, even though we have largely eliminated risk of a permanent loss, we still have not eliminated volatility from the portfolio. If he is invested in stocks, our investor must endure the rise and fall of the market. That is the reason the markets will tend to pay us a good return. Nobody inherently likes the volatility of his portfolio. No one likes to risk getting seasick. Technically, what the market is paying the investor to do is to suffer the uncertainty of not knowing when he'll have a permanent investment gain, or how much that return will be. By giving up control over the timing of our returns and the certainty of the amount, stock investors have tended to be well rewarded. So we do not look upon volatility as a bad thing. It's merely an unavoidable aspect of stock investing. In Dow Wealth Management's analysis, the trade-off of higher volatility for the potential of a higher return can be a very good one. Dow Wealth Management takes the return for enduring volatility one step further. There's a certain type of company that tends to be more volatile than others. The type is a growth company. A growth company is one whose earnings are increasing at above average rates, but also have somewhat higher price-to-earnings ratios and higher betas. If we're willing to endure the even greater volatility inherent with growth stock investing, then we might improve our expected returns. Growth companies tend to be agile businesses that maximize opportunities. Currently succeeding companies tend to have the ability to reinvest in their own futures to promote still more growth. These are the companies that tend to be at the forefront of their respective industries and are recognized as market leaders. An unavoidable characteristic of growth stocks, however, is that the trade-off for their greater total return potential is even greater volatility than what we would find with common stocks in general. As I said, there is no free lunch. If we're not paying a price in terms of a risk of permanent loss, then high-quality growth stocks make us pay in terms of their greater price fluctuations. To put the matter in terms of our boating experience, we could build a boat so large that we wouldn't even feel the waves. If we did, it probably wouldn't go any faster than a cargo ship. But we can probably build a smaller, faster boat that is equally as rugged and no less likely to sink in a bad storm. With a smaller boat, we'll feel the waves and maybe even get seasick at times when the going is especially rough. However, we should expect to make far better time in reaching our destination. The investment portfolio that we've designed is characterized by the ownership of a broadly diversified list of high-quality growth companies. And our investment strategy is to own this portfolio throughout all market periods because we know that it's futile to try to time the markets. As we've seen, if high portfolio expenses cause us significantly to underperform the markets in which we invest, we won't have a very rewarding investment experience. When my grandfather entered the investment business in the 1930s, there were predominantly only two types of investments that people owned: stocks and bonds. Most securities investors owned one or the other, or some of both. Today, however, the financial services industry has created a vast array of investment products. By investment products, I mean mutual funds, commodity exchange-traded funds, hedge funds, insurance products, real estate investment trusts, unit trusts, and the list goes on. Investment products, however, are never anything more than a package that holds equity, debt, or some derivative of them. They're merely a container. So to take IBM stock, for example, there are two ways to own it. One, we could buy an insurance product that invests in a mutual fund that in turn buys IBM. Or two, we can simply buy IBM shares for our portfolio. The first way is indirect investing. The second is direct investing. The first way is frequently enormously expensive. The second is highly efficient. The costs associated with product investments like mutual funds are both explicit and implicit. In other words, some of the costs are stated in the prospectuses, while other costs are hard to find. One major explanation for the underperformance of funds is due to a concept called market impact costs. For those who are interested, Chapter 9 of my dad's book elaborates on the subject. One way to characterize mutual fund investing, among other such product investments, is to use our anchor analogy. It is as though we were to design the perfect high-performance boat and then race it while dragging the anchor. Mutual funds were originally designed for investors with limited means who wanted to invest a few $100s each month. They couldn't afford to buy a diversified portfolio of individual stocks as wealthy investors did. Unfortunately, over the past 3 decades, the financial industry has heavily marketed product investing because it's so highly profitable for the industry, not for the investor. Investment products are now sold to the well-heeled and those of modest means alike. For investors with sizable portfolios, however, there is simply no need or even justification for the indirect ownership of their securities. To illustrate the point graphically, those who own their securities outright tend to enjoy higher rates of return as compared to those who utilize the product approach. A successful portfolio design will place us on the more efficient path. By recent example, in 2011, the S&P 500's total return was a positive 2%. The average U.S. equity mutual fund returned negative 3% before sales fees. 5 percentage points of investor return forever vanished. In short, Dow Wealth Management's view, funds have no place in serious investors' portfolios. They certainly are not needed and often are the cause of chronic and debilitating underperformance. What about these guys? What do they tell us about our portfolio strategy? What does it mean that every once in a while a rare storm will likely come upon us so quickly and with such vigor that it will sink unseaworthy vessels? And what does it mean that we cannot even rely on the weather reports for an accurate forecast? It means that our investment strategy must remain defensive at all times. For example, we can't abandon high-quality securities just because the economy looks like it's improving. There may be a surprise around the corner. So we cannot time the markets. We cannot risk owning predominantly low-quality securities even for short periods of time for fear of being caught unexpectedly. In other words, just because the weather looks good today, it still probably isn't a good idea to head out across the ocean in a canoe.